Today, after the holding pattern, hello again, it's Martin North from Digital Finance Analytics. Well, latest posts covering finance and property news. And it's a Friday afternoon, and Tarric Brooker is with me again. Hi, Tarric. How are you doing?
Pretty good yourself, mate.
Yeah, very good, actually. The weather here has been remarkable the last couple of weeks. Blue skies, birds singing, all the blossoms out, quite warm. It's actually warmer here than in Sydney at the minute. So summer's here, finally.
It's not fun. It's been real cold here. I mean, we got down to a low of 60 the other night. So it's we've inherited your weather. You've taken all the nice weather with you, mate.
Well, yeah, and I know that the UK won't be able to hold on to this for very long, but it is nice for a couple of weeks actually going around in shirt sleeves and enjoying the warmth without the humidity. It's pretty good.
No, I'm glad to hear it's treating you well, mate. You deserve it.
Now, there's so much going on, so much. And you and I were just saying off camera, it's as though we've been in a holding pattern for a long, long period of time. Markets up, markets down, interest rates up, interest rates down. But it feels to me as though we're beginning to move to the denouement. And the denouement looks to me to be one of higher interest rates for longer, central bank's credibility shot to pieces. And, where do we go next?
Well, I think the Bank of England's a really interesting example in all of this because, they were one of the first to raise rates back in 2021, but it's also looking pretty challenging there because, you've got core inflation accelerating to a 30-year high of 6.8% from a previous reading of 6.2%. It's very much become a cautionary tale, and I think that's going to be on the minds of a lot of central bankers, and that includes Phil Lowe and the RBA.
Well, it is interesting. The UK is a fascinating case study. Andrew Bailey this week has admitted that the models aren't working, which suggests,
really?
Okay, yeah, well, we could have told them that, couldn't we? Eh?
Yeah.
And the money markets, particularly the gilts, have shot up. They're now at levels that we saw last year when the trust moment hit. And that's, of course, putting a lot more upward pressure on mortgages, particularly fixed-rate mortgages that are rolling at the moment. And so people are getting real big mortgage sticker shock. But the other interesting thing is the retail sale numbers in the UK came out today, and there was a really interesting set of charts comparing value with volume. And it's a really, really important concept to understand because what it's showing is that people may be spending more, but they're not buying more. If you see what I mean. What they're doing is having to spend a lot more of their own money to buy the same things that they bought previously. And that's a really important observation. So higher interest rates, people still spending a lot more on the things they need. And by the way, there was also the debate about migration here in the UK as well this week as well, because they came out and said, 600,000 people arrived in the UK. That's a net migration number, which was higher than expected. So it's a bit like, believe it or not, the same thematics that we see in Australia and New Zealand are playing out in the UK as well. But I think the UK might be giving us a bit of a signal as to where things may be going, which is that rates will have to be higher for longer. Inflation is sticky and stubborn, and the impact on households will be significant in the long term.
Yeah, I think that the UK is an interesting example in that context, but I think it also just goes deeper around the world with, as you mentioned, the retail sales issue. Because if you look at retail sales for Germany, you look at the retail sales for France, Canada, the US, Australia, they're all underperforming in real terms. And that's a theme across the board. I mean, US retail sales peaked in real terms in March of 2021. Over 2 years ago. Yet, despite the fact that retail sales have peaked in real terms, that isn't putting downward pressure on interest rates. That isn't, the be all and end all that central banks can start saying, we've beaten inflation, because obviously it was never going to last in the first place. Spending on goods has now switched to spending on services, and that's something that's been noted by, say, for example, the Aussie banks in their card spending data, by the ABS, and you name it. So I think that some of this positive commentary, shall we say, on Australia's retail sales, underperforming doesn't really tell you anything. It's not going to stop the RBA. It's not going to make them cut interest rates. we're still, this is still very much early days, I think, in this particular cycle in that regard.
Yeah, David Taylor from the ABC made an interesting Twitter, which I thought actually sort of missed the point, really, the point you just made, which you've got to look more broadly.
Yeah, that retail sales, yeah. I think that I think the thing is that with retail, it is underpinned, price rises are underpinned by demand. They're also underpinned by the fact that costs are rising. And, the corporate profits issue one is a complex one, because it's all well and good to go, corporate profits are through the roof. But then when you break them down by industry, obviously it paints a bit of a different picture, because a lot of it's the mining sector and the resources sector making money hand over fist. But yeah, I mean, I responded to his tweet and basically said that, if you look at some of, say, for example, the ABS services data, you are still seeing rising spending and still relatively robust rises in spending too. So I think it's also the fact that if you get granular, as you like to say, with the retail sales data, the one that is really, really underperforming and is really dragging down the average is household goods. And household goods is very much linked to housing activity, in particular housing turnover. So, you go out, especially first home buyers, you go out, you buy a new house, you do the classic Aussie thing where they go out to, Harvey Norman or Domain or Freedom or whatever, and they get the whole house furnished, 48 months interest free, you name it. And that obviously stimulates retail sales growth quite considerably. But now we're seeing that fall away. Unsurprisingly, retail's falling away. And also, realistically, how many televisions and couches do we really need, considering how many we've bought since the start of the pandemic?
That's exactly right. And again, going back to the UK retail sales, the food value has gone up dramatically, but the volume hasn't, because people are paying a lot more. Inflation in food in the UK is dramatic, and that's putting a lot of pressure on other sectors as well. So I think there's a lot to do to really get below the headline when you look at the retail sale numbers, as you and I both do. And I think it's important that people understand that it's not quite necessarily as positive as many would like to portray it.
No, and I think one of the interesting things as well is that when you look at the state by state breakdowns, that's where things take another twist entirely, because you look at, say, for example, this month's numbers, the worst performing states were Victoria and New South Wales. So yet by the same token, WA saw a 1% rise month on month and is actually looking relatively good on that particular metric. So I think it's interesting just to see how the states with the lower levels of household debt are generally performing better, and the states with higher levels of household debt are generally performing worse, which is something that we'll get to later with the slides.
Absolutely. Before we do that, it's just worth reflecting on New Zealand, of course, because they, again, put their rates up. And I listened to Adrian Orr's actually quite stout defense of he and his strategy, but he actually did admit to taking accountability for the decisions. And I actually think it's the first time I've actually heard a central banker, actually put a human face on it and take accountability. It's quite interesting.
I think that we've had a very much an accountability deficit or an accountability shortage since the pandemic began, because none of the politicians want to take a responsibility for what they've done. None of them want to take responsibility for the fact that they are arguably, at least half of the cause of inflation. They threw this huge amounts of money at the economy, and unsurprisingly, it created large amounts of inflation. Whereas you look at places that didn't throw huge amounts of money at the economy, that didn't crash dive interest rates, and they're performing a lot better. I posted a tweet a few months ago saying what a great job the Bank of Indonesia had done, because they didn't crash dive rates. They kept rates at a reasonable level. They raised rates at, when they needed to, and they didn't overstimulate. And now their economy is growing brilliantly. Whereas we did the complete opposite of that, and now we've got to deal with inflation. So, yeah, I think that. But by the same token, you're not going to get that from any central banker or any sort of head of state or senior politician who doesn't want to admit the mess that they've created. I mean, and not only that, it's all well and good for some in Labor, to say, oh well, Morrison, but it's like, well, you guys were backing pretty much everything he was saying, so it's on you as well.
Absolutely, and of course, The convenient excuse of Ukraine and COVID and all those other things, right? I mean, they were part of the puzzle, but the core of the puzzle was actually the dramatic cutting of interest rates and the massive amounts of liquidity flooded into the economy by both the central bank and, of course, by the politicians too. So there is plenty of blame to go. As you say, nobody wants to admit they did it. And the point that I think you and I would both agree on is that this inflation has now got itself to be sticky. It's actually flowing into services. It's linking into some of the wage rises. And so the prospect of trying to sort of turn the inflation wick off quickly is probably now pretty doubtful. It's going to take some time, which means that interest rates are going to have to stay high for quite some time too.
Yeah, I think that it's obviously, it's going to be very depending on locale. Obviously, the UK probably has the most stubborn core inflation currently in the developed world, or if not, it's up there. It's probably up for debate. But I think one of the interesting ones is looking at the different drivers of that core inflation. Because if you look at, say, like the UK or the US, it's very much at this point fed into wages, particularly in Britain. But if you look at Australia, we've still got relatively anemic wages growth when compared with the headline rate of inflation, or even the rate of trimmed mean inflation, or whatever your preferred inflation metric appears to be. But what we do have here in Australia is equity, mate. And we've got the psychology and the hugely cashed up boomer demographic who are, some of the most wealthy people in the world per capita in terms of overall household wealth by nation, I should say, on a per capita basis. And I think that that's going to be really, really interesting to watch, because you've got entrenched inflation in places like Britain because of not because of wage inflation, but partially because of wage inflation. But in Australia is a resurgence in equity, mate, and housing credit potentially going to help entrench inflation here in Australia. And that's something I've been meaning to ask you. Have you seen, signs of that sort of resurgence in your own data?
Yes, I have. So one of the things I've seen is the banks have been much freer in terms of refinancing in recent times, in the last 3 or 4 months. And it's interesting that the solution that the banks are offering is to refinance over a long period of time, take out some additional equity to support your cash flow over the next year or two. And that kicks the can down, right? I'm seeing it, amongst households that you would think, well, they're pretty close to the wind, but there are a lot who are refinancing that have significant equity and, can just plain sail through. And I suspect that this is the subtext behind some of the recent APRA comments, for example. And I think they're okay with it. I'm a bit concerned about the amount of just debt on debt on debt that we're creating as a result of it.
Well, I can't really say I'm surprised. I mean, is there any sort of relaxation of credit for new loans, or is it mostly just focused on sort of keeping the plate spinning, so to speak, with existing mortgage holders?
A lot of it's to do with the plate spinning, so keeping the mortgage holders out of the delinquency bucket. Obviously, the last thing that the banks want to do is to say that they've got rising delinquencies, although, in fact, if you look carefully at, for example, non-conforming lending, the delinquencies there are rising now quite fast, and I suspect we'll see others later. But no, it's about plate spinning. Talk to first-time buyers, and the first-time buyers are really still finding that the borrowing power is crimped, and the ability to be able to do much is a real problem. And of course, the recent decision with regard to payday lending is going to add an extra factor in that, because quite a few of them have payday loans as well. And sorry, take that back. And of course, the recent change to buy now, pay later lending is going to put extra pressure on as well, because quite a few of those people already have buy now, pay later loans, and that's now going to be put in the credit bucket too, which means they've got less available credit capacity. So it seems to me that we do have this divergence between the new first-time buyers and the existing plate spinners. But of course, you've got to expect states to throw more hooks out to catch more first-time buyers, because that's what they're going to do. Surely that's what they're going to do.
Well, they've already done it in a way, haven't they? I mean, you look at New South Wales, they've raised the threshold for stamp duty-free transactions for first homeowners. And, you know, I'm just waiting for the other states to follow, because they inevitably will.
Well, they will. Absolutely, they will. And of course, the APRA, well, you know, rates aren't going to go much higher now, so we can reduce the buffer. That's coming. I mean, all of it's in the, you know, in the mix there somewhere, because let's face it, it's the housing lever that they're going to pull to try and actually keep the economy out of you know, out of the ditch, as it were, and of course the migration one, and that's sort of connected. The real interesting question is, to what extent are the loans that are actually being rewritten with more equity, you know, good loans versus bad loans, or are they all hoping that magically interest rates are going to come back down in the next year or two and wages are going to start taking off, and therefore it's going to, you know, be a get out of jail card for the banks? Or have they actually essentially just signed their own death warrant, insofar that what they're doing is just building the Ponzi up to a newer, higher level, and then they'll have a bigger problem later? I'm not sure which is true at the moment.
I think the thing is that the decision makers who are, you know, pursuing these courses of action, most of them basically have no conception, you know, no sort of personal conception of how this could play out if things go bad. And I think that's, you know, like, I think that's a big part of risk management, because if you're trying to manage risk and you haven't experienced that risk, and you don't have a mentor who's experienced that risk, and that hasn't played out in your nation in a meaningful way in well over 30 years, I think it's really challenging to sort of, you know, wrap your head around it and then sort of manage that appropriately. But by the same token, we all know that if the big banks get into trouble, that the government's going to come right into the rescue. I mean, it's like sort of plain as day. You know, even you look at reports by the, you know, the Bank for International Settlements. They're just like, this is basically, you know, 100%, you know, guaranteed by the Australian taxpayer. So I think it's going to be interesting to just see how that sort of evolves as the direction of the economy becomes clearer, and as, you know, the potential downsides become a little bit more real, shall we say. Because, you know, you look at some of these super funds, they're positioning for a recession. They're positioning for, you know, a serious economic downturn. And, you know, and then there's also issues with China. What's going to happen with that? You've got, you know, a lot of various Chinese cities now finding themselves in trouble with paying the debts on their, what would you call them? Their financing vehicles, which they use in order to buy land from themselves in order to keep their own revenues up. You know, things are looking shaky. I mean, there is a scenario where China stimulates and everything goes to the moon, and that would be great for Australia. But there's also a scenario where they're a little bit more circumspect, where they just allow things to, you know, in this slow glide path down. And if you combine that with a US recession, well, then I don't think these decisions from the banks to extend these terms like this may look so rosy.
No. Well, you know, recession is interesting, right? So New Zealand is forecasting a recession. A mild one, but a recession. The German economy is in recession, according to the latest data that came out yesterday. Jeremy Hunt, who's the Chancellor of the Treasury, if you like, in the UK, said in an interview that if a recession was what was required to get inflation down, then so be it. And all of the stuff I'm reading in the US is suggesting a recession is coming there, but it's just being pushed out a bit. So, you know, there does seem to be a lot of our words around, and the China bounce post-COVID was not as big as people expected, and it's pretty short-lived. So, as you say, unless they throw another big stimulus spanner in the works, they could have a recession too.
Yeah, I mean, I think the thing is that even 3% growth is basically a recession for China, because it's also about the makeup of that growth. You know, even a mean reversion, for example, in retail spending to 2021 levels would still get them, you know, a fair chunk of the way to their growth target. But the big question is what's going to happen with land sales? What's going to happen with steel? What's going to happen with the commodity complex in that regard? And on that particular front, things don't look that great. You know, steel demand and steel consumption are both well below 2021 levels and 2020 levels. And they're sort of sitting around about 2022 levels, and actually a bit below. And that's just not good enough, because 2022 was defined by lockdown, and 2022 was also defined by, you know, the curbs on the Chinese property sector. And even if you look at some of the more recent data that's come out even in the last couple of days, the demand just isn't there again yet. And I think it's going to be challenging in order to sort of you can't stomp on the property sector and say houses are for living in, houses are for living in, houses are for living in, and then turn around and go, please invest in housing at 40 times household incomes, please. It doesn't really work like that. It's very hard to shift, public opinion like that, I think.
No, I agree. And just a quick aside, of course, the US dollar price of steel is down as well, right? So, that's not surprising because, of course, demand is down, therefore the price is down. And interestingly, the oil price is down as well. But again, that's because of lack of demand, right? So these things are signaling, I think, some trouble ahead. Now, we did actually throw out the invite for some questions, and I suspect
we should probably get to them.
Yeah, exactly.
Okay. Steve asks, to what degree do you think mortgage prisoners are affecting new listing numbers? Those who might want to trade up or sideways can't get new borrowing approval, so they're choosing to stay put.
It's a very good question, and certainly in my surveys, I'm seeing a lot of people who would, over the last few months, have wanted to trade up or move, or even for jobs. They can't, so they're stuck. It's about 5 to 6% of those people with mortgages at the moment who are effectively mortgage prisoners now, and that means they can't refinance because their loan-to-value ratio or income ratios are not appropriate, which means they're stuck where they are. By the way, many of those, of course, are going to be moving to the current variable rate because they're on fixed, and that's about to flip over. So it's a significant proportion, but it's not equally spread. So if you look at where the mortgage prisoners live, you can pretty much say it's on the outer suburban areas of our major cities predominantly, as well as some of the areas closer in, particularly the high-rise apartments. But it's correlated with high levels of mortgage stress. So you can pretty much read into where there's high levels of mortgage stress, there are high levels of mortgage prisoners, and that's having a significant listing problem. The other point about listings is that if you look carefully, most of the property that's listed at the moment has been around for some time. So the number of new listings is significantly down. And what that means is that some of the properties that are on the market are actually sort of old investment properties that need work, or less salubrious properties that need work. So there's less what I call prime real estate coming on. So it's the different quality mix as well as that. And by the way, some of the people who are putting properties on are also mortgage prisoners in a different way, but they're actually in the investment sector. And what they're doing now is just trying to get out at any cost. So some of the properties being listed are where the investment mortgage has gone through the roof. They can't refinance, they can't make it work, and they're trying to sell the property. So it's a complex picture, but that's my take on what I'm seeing.
Yeah, so do you think that that's also just affecting sort of normal up trading, down trading people who aren't necessarily mortgage prisoners, but people who just no longer can get the size of loan that they need to in order to up trade? Do you think that that's like a significant factor, going by your data?
Oh, it's quite clear to me that some people are choosing to withdraw from the market and just sit on the sidelines and wait and see what happens, partly because of the uncertainty, partly because they don't know where interest rates are going. And the other point is that some of the people who are selling, and particularly down traders, there are some down traders who are thinking, well, I'm sitting on big equity here, maybe I should sell and get out. They don't want to meet the market. So they're not prepared to effectively drop their asking price to a price that prospective up traders feel is appropriate and responsible. So there's a big gap at the moment in terms of meeting the market. And a lot of the people who are in property at the moment are saying, well, maybe I should just sit and wait and see how this plays out because of the uncertainty principle. It's too I don't want to commit myself more than I'm committed at the moment. So all of those things I think are playing in, which is why I'm of the view that we will see some listings going up probably in the spring, but I still think that the listing numbers will be significantly lower. And that's going to put a bit of a support on property prices in some areas.
Yeah, that's what I'm saying. I mean, like, we've got a chart later on in the show that shows basically that total listing numbers compared with 2019 levels have just collapsed.
Yep.
And we're probably missing out on, in some months, well over 10,000 new listings that in the capital cities that just aren't happening. So I think that we've reached this point now where we've got this pent up, that there is a lot of, people say there's a lot of pent up demand because of rising rates. And, I concur, that's true, but there's also a lot of pent up supply. So I do wonder exactly how that's going to play out in the longer term, mostly because a lot of property transactions are for what I would call life happens reasons. You need a bigger house because you've got kids, or you need to split up one household into two because of a relationship breakdown or whatever. And I think that those sort of transactions can only be postponed for so long. And I do wonder just how that's going to play out in the longer term. But the big one for me, I think, is the rental crisis. Because you look at these cities that don't have the issue with the rental crisis, they don't have the same level. In some cases, they don't have the same level of suppression of new listings. So I think that's going to be an interesting one because, well, who would want to sell in this market and then try and navigate the rental market? It's a bit of a challenging situation.
Oh, totally, that's correct. And the rental crisis is getting significantly worse, not least because, of course, property investors are being almost forced to put their rents up because of the interest rate rises that are actually coming through on their mortgages. So it's a no-win situation. And I think the other point in all of this, you mentioned the listings numbers. Now, we're talking here about the listings numbers on the portals, right? But there are two factors that people should understand. Firstly, there are a lot of properties that are silently listed. So they're not actually available publicly, but agents know, and they know that if they have somebody comes up with the right money, then there's a deal. And secondly, and I spoke with Edwin the other day, some of the suburbs, people are now not using the property portals, but they're using social media or other means to be able to actually put the properties up. And so I wonder whether we are actually getting the full story with regard to what the listings numbers actually are. And one of the things, of course, which is missing now is the settlement data that used to come through from the ABS, which means that it's difficult to read now how many transactions are actually happening. And actually, my own reading is suggesting that there might be more property transactions than the listings might actually suggest.
Well, that's an interesting one because, naturally, housing turnover is a big one because, as we discussed previously, if housing turnover picks up, retail could pick up in some ways. And, well, it's also a big one for the state governments.
Yep. Stamp duty. Yes, please.
Yeah. Okay. Liam asks, buy now, pay later is a new and up until, the recent changes, unregulated financial instrument since the last economic downturn. Is this easily accessible source of finance being adequately weighted into consumer spending behavior in economic forecasts?
No.
Yeah,
it's not. Two reasons. One is because it's very hard to know what the incremental impact is, right? Remember, buy now, pay later essentially is spreading payments on existing credit cards or on debit cards, right? So it's very hard to get a good read as to what the credit impact is and to what extent is incremental. But my surveys show me that there are households under financial pressure who are reaching for multiple buy now, pay later solutions to be able to get by. And they're not just buying things like TVs or whatever, but they're actually even putting, electricity bills and everyday expenses on buy now, pay later. And one of the reasons why this is important, Treasury did a report quite recently saying that, this is one of the factors that's creating significant pressure on many households. The ASIC report previously showed the same thing. About 20% of people end up paying excess fees and things because they can't settle it. So this is a big deal. Also, the point is a lot of this is not yet flowing through into credit scores and credit ratings. So this whole area is completely opaque. And that's quite convenient, of course, for the buy now, pay later entities who are claiming they're not really credit providers, although, of course, they're now backpedaling and saying, of course, regulation like this is good. Remember, there were three options that were put on the table, do nothing, do a little bit, or do proper credit regulation, and they've ended up in the middle, all right? So I'm of the view that whilst this is a step in the right direction, it's still not sufficient. And as I keep saying, if it quacks like a duck, it looks like a duck. probably is a dark, right? In other words, this is a credit product. It should be regulated like any other credit product. It should be in all of the models because it's a critical element within the way that households are actually financing and refinancing. And it helps to explain why some of the other credit lines and personal loans and even credit cards have been dropping.
Yeah, absolutely. Although in more recent times they have been bouncing back quite a bit for the first time in a long time.
But not uniformly across all households. So you can see here the significant rise, particularly amongst those stressed households that I see in my survey. So guess where all the credit growth is? It's amongst people who've got no choice but to try and keep those plates spinning again.
Well, I think that's sort of a little bit overlooked when it's all, oh, everything's fine and rosy. Everyone's coping fine with everything. And, no one's going to default on their mortgage.
Everything's good here. The sun's shining. Everything's good. Yeah.
Well, I think the thing, there's a lot of products and a lot more options, so shall we say, for people to pursue now, even in terms of, say, for example, like, various different hardship provisions that perhaps didn't exist in the past. But also, as you say, the buy now, pay later thing. And I mean, I did a bit of research on it today. And as this is RBA data, obviously, as you say, it's an opaque thing. So whether how accurate this is and how much it captures the full market is naturally open to debate and very much open to questioning. But they came to the conclusion that in the last financial year, it came to $16 billion. Now, $16 billion is 4.5% of all retail spending.
Yep.
So that's a fairly sizable chunk of overall spending being put on, the Never Never. And according to a study from BIX Oxford, they concluded that 38% of Australians used buy now, pay later. So I think that just goes to show that there's, this concentration issue, as you say, once again, that that particularly for some of these stressed households, that they are turning to these, other avenues to support themselves.
Yeah, and Fiona Guthrie, who's in the financial counselling industry, made the point quite rightly. The trouble is not just the odd buy now, pay later, but when you've got 4, 6, 8, 10, that's when it starts to get into difficulty. And that's what I'm seeing in my survey. So, there is a concentration. And I think the 38% is about right. That's what I see in my survey. So it's quite widely spread. But if you look at the loan concentration and the loan counts, that's a much smaller proportion of those who are using them. And unfortunately, a lot of people are paying one off and then getting another one to sort of keep that one going. And so it's this old plate spinning problem again. And it's concentrated again in those sectors of the economy where households have little in the way of other options. And, some of them mortgage prisoners, some people already have payday loans as well. I mean, it's a mess. And until we get to the realization that all credit needs to be actually understood to be able to understand what the total exposure of a household is, we're never going to make the right decisions. And that's true from an underwriting perspective and also from a policy perspective.
Yeah, and I think it's also just worth adding that, if you've got this, sort of up to even with the data that we have, that is still relatively a black box. There's also the issue of equity mate.
Yep.
Which we don't get regular data on. The data that I have on it that's the most recent is from 2021. And yet it injects, according to the last data from 2021, $93 billion into the economy. Now, obviously that injects it in very different ways. Some people just go out and directly buy things. Other people use it to invest, or other people use it to inject cash into their business or whatever. But either way, it's generally cash into the economy.
Yep.
Yet our understanding of it on an ongoing basis is extremely minimal. And the only ongoing data that we do have is from your what percentage of external refinances are actually accessing home equity. And just on that one, how's that looking? Are we seeing further new highs, or are people starting to pull back a little bit?
It's going up again. So it dropped back. And remember, I think I supplied data that showed it has fallen, it's come up again. So I mentioned earlier on, that's because the banks have been a bit more free with their ability. And, one or two banks have publicly said, well, what we're doing is we're allowing people to grab a bit of extra money so that they can keep their cash flow going. The trouble is, of course, the assumption is that people are going to use the money wisely. And that's the problem. Some do, but unfortunately, some people, I suspect, will go on a binge. A bit like when the superannuation withdrawals were there. Quite a few people withdrew money out of superannuation, didn't actually use it that sensibly.
Yeah, that seemed to be sort of, I mean, from the surveys and various market research that was done on that, it seems to be that most of it went on consumption. It didn't really go on the things that you was meant to go on. And I think that actually really just nicely just illustrates that what a mistake that policy was, even in terms of inflation, because it was open-ended. No one knew exactly how much people were going to withdraw or how responsibly they were going to spend it. So instead, it ended up just firing up demand. And now we're here dealing with this inflation problem.
Yes, and just going back to what we said earlier on, inflation was caused ultimately by the creation of lots of money, lots of liquidity sloshing around, chasing the same goods and services. And that is actually the root cause. And the other stuff, well, followed on. But nobody wants to talk about that.
Indeed. And we should probably get on to the next question. Paul asks, given the current immigration policy, what is the effect of large immigration on inflation? And do you think that could lead to higher interest rates?
It's a very interesting question because, of course, it depends on who's coming, what they're buying when they come. And I don't know what your read is, Tarric, but it seems to me that the business community are after large volumes of warm bodies that they can pay little to be able to actually make their business more profitable, right? And if that's true, then it might not have a significant impact. But if in fact what you're doing is bringing in a lot of people who have significant pent-up demand and significant capacity to buy, then they could actually really, lift demand, therefore prices, and also lift wages, and therefore prices indirectly. So it seems to me that there is a very important correlation between what happens to migration, what happens to inflation, that probably isn't fully understood.
No, I don't think it is. And I don't think that we have the level of granularity and the level of timely data to really be able to just fully determine that. But I mean, even if we just go by some of the recent statements by the RBA that they shared their concerns that high levels of migration, and in particular its impact on the rental sector and keeping rental inflation high, could create further inflationary pressures, which could put further upward pressure on interest rates. Now, on a longer term basis, it's likely that the expansion of the labour force is going to put downward pressure on inflation because it's going to put downward pressure on wages. Now, as to how long that's going to take to play out, that's anybody's guess. But I think that the RBA is right to be concerned, and I think that but they're also a little bit lucky that the ABS revised down the weight of rents in the old CPI. Otherwise, they might have a more serious problem.
Yeah, that was a very convenient revision, wasn't it? You wonder why. And the fact is that when you have more people chasing goods and services, intrinsically, you'd think that would be inflationary.
Yes, and I think it's going to be an interesting one in that regard, just to see how things can keep up. Okay, MSR asks, do you think inflation can be contained without a recession? Reflecting on the macro trends you've covered, how do you see the economy holding up under a recession?
So, as I said earlier on, recessions are definitely, popping up. And remember, a recession is a reduction in overall GDP output. And remember also that when you look at it on a GDP per capita basis, we've been negative territory for quite a long period of time in any case. So partly the measure itself is a bit flawed. The point, though, is that once you get into a recessionary environment, it tends potentially to lead to deflation, which means that prices might fall, which might be good for inflation. But it also then puts other pressures on the economy. And I've had this theory for a long, long time that ultimately we might be entering a deflationary phase, because effectively one thing that happens in a recession is that credit becomes less available. And at the moment, as we said earlier on, the whole economy is supported by credit, housing credit, buy now, pay later credit, other forms of credit. So that is a problem insofar that what you're doing is essentially reducing the ability to be able to keep the bubble going, which is highly deflationary. So for me, recession, deflation is definitely a real risk.
Yeah, I concur. I think that that's a possibility. I think it's just going to be interesting to see exactly how much, because the thing is if things, if crap really hits the fan, you're starting to see potential sort of signs of that in arguably in commodity markets at the moment, in oil and copper to a degree, particularly considering the supply backdrop issues. But I think that the broader problem is what is going to happen and what is going to happen with governments. My sort of feeling is that they're going to do something stupid, like they're just going to throw more money at the issue, and they're going to basically turn a deflationary bust into an inflationary, in basically just set us back to where we are now, because they can't stand the idea of a protracted recession that basically, in a lot of ways, that we do need to endure, just so the zombie companies die off, and basically we can get on a better sort of path forward. And that, ironically, that's even something that a parliamentary inquiry into Australian wages growth found. They said that Australia has too many zombie companies. It has too many companies that basically aren't sufficiently productive, hoarding the productive workforce, and that's one of the reasons why Australia has such poor productivity and wages growth. So, but by the same token, it's politically unpalatable to have a recession. So it's going to be interesting in that regard. Although I think it's going to be pretty easy for them to reignite inflation by accident.
Oh, well, yes. And stagflation, of course, is the other scenario, which is basically when you have high inflation, but actually everything else goes backwards. And, the stagflation story seems to me to be probably the most strong in the short term. We'll certainly see it in other countries as well. So where you chase your tail, trying to get inflation down, you lift interest rates, you kill off other things, but inflation doesn't go away. That's a scenario that I think is worth exploring, because essentially that is the precursor then potentially for recession or depression later.
Yeah, I would agree. I mean, I think that once again, Britain is probably the sort of leading, the canary in the coal mine, so to speak, on that one, because, it's further down the path than the rest of the world.
Well, it sort of is, except, of course, energy in the UK is coming down now. So they announced earlier in the week that the energy costs are dropping and will drop quite quickly. In Australia, energy prices are looking to be rising. So you might be behind us in the UK.
Well, on that one, yeah. I mean, I will say I'm going to go out on a limb here, and I'm going to make a prediction with 100% certainty. And I don't do that very often, but here we go. There is going to come an Australian quarterly GDP figure that is going to come in quite low. Not GDP, sorry, CPI figure that's going to come in quite low, and that's going to be because of Albo's little energy scheme where he gives households up to $500 depending on what state they're in. And that's going to distort the crap out of a CPI figure. And there's going to be people who are going to take their big old victory laps, annualizing the figure, telling everyone that inflation is dead and that rate cuts are just around the corner. But it'll be a mirage, just like it has been in parts of Europe who've done the same thing. Who've said, "Oh, look at this great info. Look at this great inflation print. What about the fact that you guys did a huge energy subsidy that cost you hundreds of billions of euros?" Yeah, we're not talking about that part.
That's exactly right. And it goes back to, if you just go with the headline news, you miss the critical issue, right? These inflation numbers are fudged dramatically and can be influenced dramatically by specific policy areas. But of course, remember that when you actually put a policy support in, it ultimately drops out again.
Exactly. And you'll see this huge big increase as things not only normalize, but rise with the rising costs of gas and electricity. So yeah. But that it's unavoidable, and we'll let them have their fun.
Absolutely. By the way, in the UK, the inflation number showed a drop in the energy inflation this time because of the base effect from 12 months ago. But it was other costs, particularly services costs and wages growth and food prices, all those other things, which were still there. So they didn't get the number that they expected, as we discussed earlier.
Yep. Okay. This question is probably best answered with me sharing some slides. So I'll do that now. Okay, as usual, folks, the charts will be available at avidcom.substack.com. If you would like to make a contribution to help my my work here with Martin, or just my Substack in general, or my Twitter, please feel free. That is all very, very much appreciated. And we'll get on to the question.
Just say, I just want for you, the AI thing, right? That is perfect. It is flavor of the day. I mean, everyone's talking about it, right? And it's another hype. Let's just pause on that and then carry on.
Yeah, no, it's insane watching Nvidia, isn't it?
Yeah.
You know, just go up and up and up and up, and then you've got the shorts, and then you've got the short covering, and then it's just, oh, it's an absolute. I mean, I think they said the other day that Nvidia traded more in the first 10 minutes of the market being open than it normally does in an entire day.
Correct.
Okay, on to the questions. Shan asks, apparently the unemployment number has gone up for 3 of the US states. Can you dig a bit deeper on Australia's number by state or other granular? Because the mortgage cliff is peaking, this seems like a rather key thing for the inflection point. So there hasn't really been that much movement in the unemployment rate, mostly because it's so low and there's still a lot of jobs out there. But what I've done here is I've taken 6 job ads and then broken them down by state. And you can see that, once again, the states with the highest level of mortgage debt and the highest levels of household debt relative to income are the ones performing the worst.
Well, there's a surprise.
Yes, we're all very, very shocked. Although I will note that part of the issue with Seek's data is Seek struggling with market share. And that was one of the, I imagine, this is just my theory, don't put too much stock in it, that's one of the reasons why they were replaced by Indeed for ANZ's job ad index.
Yeah, I noticed that. And interestingly, the unemployment rate, of course, is higher in places like Tasmania, for example, than some of the other states. And by the way, mortgage stress is very high in Tasmania because of it. Some of the other states, it's a little better. And there are state variations that are worth looking at. But the other point is that in the smaller states like the NT and the ACT, the numbers go all over the place because it's just such a small count. So you really can't rely on the state data necessarily, I think.
Yeah, that's why I didn't include it. It's because they're such small labor markets and small populations that it's so volatile, especially if you see some duplicate ads, all of a sudden it just all just falls to bits.
Yep.
Okay. Now, while that is what Seek says, and while Indeed and ANZ have also noted the fact that Victoria and New South Wales are weak, the actual decline in overall job ads and job vacancies is actually been relatively mild.
Yep.
So, and I put more stock in these particular indices in terms of their ability to sort of give you an idea where the labour market's going. It's also part of the reason why I don't buy the latest set of ABS unemployment numbers. Once again, there was issues with sample rotation for
absolutely.
I think it was the 5th time I think in the past year. So yeah. If Australia is losing jobs on these numbers, particularly with population growth and labour force growth as large as it is, we've got a huge problem. But I don't think that's happening yet.
No, I agree. I also looked at the sampling and thought, there we go again. So you can't rely on the ABS data.
Yeah. Yeah, I mean, it's unfortunate, but it is what it is.
Yep.
Okay. Now, this comes from a question from Logan. How high did interest rates rise in 2006 and 2007, which caused the GFC and the housing crash, and how does that compare to Australia? Now, this is an interesting one because interest rates in the US, it wasn't so much that rates rose to a huge degree. They rose. But the biggest problem for a lot of these people before the recession started was the fact that they got teaser rate loans.
Yep.
They got these loans that were, sort of 1.5% or 2% below the prevailing mortgage rate at the time. And they had it for, a year, 2 years, 3 years. The on the right there, this August 2007 case study was one done by a CNN at the time, which basically detailed a sort of common loan that was being written during that period and how much rates rose. So they had 2 years at 4%, which was very, as you can see from the chart on the left, was 4% was extremely low, an extremely good interest rate to be having on a mortgage. But then they rolled off onto a much, much higher loan, which increased their repayments by 39%. Now, Australia had something similar because the fixed rate loans and variable rate loans were still about, call it 1% apart in terms of the average rate payable, according to the data from the RBA. So if you got a two-year fixed rate loan written at about 2%, which was the average rate according to the RBA, some got a lot lower, some got a little bit higher. Obviously, it depends on circumstances, but that was the average. And you're now rolling off that 2-year fixed loan now onto the average variable rate payable. Your repayments are increasing by 61% versus the Americans' repayments, who increased by 39% on their teaser rate. So things are more challenging for people rolling off loans in Australia today in terms of the overall increase in mortgage repayments compared with the sort of standard case study back in 2007 in the US.
Yeah, the other factor to bear in mind, of course, is that a lot of the US mortgages were securitized pools. And so a lot of those bad loans were actually in the mortgage pools, and those mortgage pools were shared between banks, and the banks didn't know what they'd got. So they had a whole bunch of additional risks. Now, in the Australian context, we don't have that same cross-collateralization that they had in the US. Although I have a view that the banks are being a little bit flexible sometimes in the way that they report their bad debts and their delinquencies. But that secondary factor, which really, I think, created the global financial crisis, is not necessarily in Australia to the same extent. And of course, you made the point earlier on that it's worth repeating, I think. The government will save the banks.
Yes, they will. And I think that there's also the factor as well that banks aren't going to be nearly as foreclosure happy here in Australia as they were in the US. Like in the US, it was, obviously everything fell to bits. Loads of people lost their homes. I mean, I even know some people who lost their homes. And, the idea of sort of holding on for dear life, wasn't anywhere near as prevalent as it will be or would be in Australia should that scenario come to pass.
Well, that's true. And as I said earlier on, we're already seeing the banks being flexible in terms of extending term, allowing people to pull out extra equity to be able to manage cash flow. The last thing the banks want to do is to engineer a foreclosure event and crisis because they don't want those numbers to rise. So they're doing everything they can to keep them low at the moment. And so my expectation is that we won't see massive spikes in foreclosures. But I am seeing a lot of households, nevertheless, thanks through the mortgage stress surveys, really struggling with cash flow. And it's the second order impact. When they have got cash flow pressures, they stop spending.
Yeah, agreed. It's going to be the issue in terms of the slowing economy, the impact on unemployment, and even just hours for a lot of people who are really walking a fine line. And I think it's also just going to be a case of how comfortable people can become with their discomfort in terms of being behind on their mortgage and what options they're going to have. Because for the moment, it's more comfortable for a lot of folks to be able to just deal with the bank, to be able to pursue these other options in the short term, rather than go into the rental market, which is a nightmare. But if you're talking about a housing market that's that's less challenging, where the rental market is more normal, where perhaps even rents are falling or vacancy rates are rising, then all of a sudden the calculus changes a bit, and you think, well, am I more comfortable dealing with the bank on this ongoing basis that I really don't want to be dealing with it, or would I rather just sell the property, realize a loss or a gain or whatever it is in someone's individual circumstances, and just rent and not have to deal with that particular stress? So I think that's going to be a big one.
Yeah, you're talking about the substitution issue, right? There is very little substitution available for somebody who's potentially thinking of selling their property. And that holds them in and forces them effectively to try and juggle the plates for a bit longer. and hope for the relief from higher wages or low interest rates or something. But I have to tell you that the social pressures and economic pressures that creates has long-term consequences.
Yeah, I mean, like, this is something that I've seen personally plenty of times, growing up in a low socioeconomic area, particularly with people who are not the greatest with money. And, you see the pressures even on, households, on relationships, on families. It's, it's all well and good to be able to say, oh, well, the bank is helping me out and they're letting me do X, Y, and Z, and that's keeping me in my home. But it doesn't necessarily, for people who are, shall we say, a little bit more prudent, a little bit more concerned with, the sort of past today and tomorrow into the next week, next month, etc. They don't want to live like that. They may not want to live under those circumstances if they have a choice otherwise. So I think that's going to be something to watch going forward.
I agree.
Okay, we've got a couple of other slides that don't relate to questions. Capital City asking rents from SQM Research, and I think this illustrates nicely that you've got this divergence between Sydney and Melbourne and the other capitals, where Sydney and Melbourne are rising strongest, unsurprisingly, considering the fact that the number of temporary visa holders rose by over 250,000 in the 3 months to March 31st, but also the divergence between units and houses. Houses in a lot of places are slowing. So, say for example, take Brisbane. Houses on a quarterly basis have only risen by 1.2%, which is below the rate of inflation. Yet units have risen by 5.2%, which, so you're almost getting a full whack of inflation in a quarter. So you're seeing this two very different elements of the market performing very, very differently. And I'd say that this is largely related to issues with the rental crisis, with people just trying to find the cheapest accommodation possible.
That's very true. And again, I'm seeing that in some of my surveys where people are actually just looking for, something small, something cheap to try and actually solve their problem. And in some cases, that means it's a unit.
Yeah. I'd also add that in the smaller capitals, places like Canberra, Hobart, Darwin, we are starting to see slowing, and in some cases, falling rents. So, for example, houses on a quarterly basis are now falling in the three minor capitals. So, without that additional demand, without the rental crisis propelling things upwards, things look quite a bit different. And, if we're sitting here in a year's time and things look like that outside, I mean, obviously Sydney and Melbourne may take longer to solve, but if we do start to see even houses in Perth and Brisbane, I'd say are moving towards a normalization. But, I think that that's going to be something interesting to watch, because if you do start to see a normalization in the rental market, one, things are going to get better for people, which is going to be, a positive development. And two, there's implications for the broader housing market overall.
I agree. And it's interesting, if I look at Hobart, for example, I have seen a bit of a spike in investors essentially saying, well, I just can't make this work now. I can't put the rentals up anymore. The costs of the rent won't cover the cost of the mortgage. Therefore, they decide to sell. So one of the reasons why some of those investment property listings are rising in some of the smaller centres.
That's really interesting to hear that, because while Hobart's rental market is performing quite poorly in terms of falling rents on a quarterly basis, I think it's also quite interesting to think that Hobart is actually also one of the worst performing capitals instead of in terms of home prices. So one wonders if other locales are going to follow Hobart's example once their rental markets, move towards that normalization.
I think it's quite likely. I've had a number of one-to-one conversations with people in Tasmania, and they're trying to figure out, they've got this investment property, the value is dropping, they can't put the rent up, the cash flow doesn't work anymore. And by the way, a lot of the people have never calculated what the net rental return is, then look at the gross, and of course that doesn't tell you anything. So when you actually start showing them the trends, the reaction quite often is, well, maybe we should think about trying to get out before things drop more. And it's a sort of a self-fulfilling prophecy in a way, isn't it? Because if more people effectively are going through that cycle, then you have more downward pressure on on property prices, and then that pushes more pressure on the investment sector. I remember that, of course, Hobart, if you go the prior couple of years, had a massive run up. So many property investors are still sitting on equity, and what they want to do is to release that equity before it disappears.
Yeah, makes perfect sense. Okay, now I really like this one. This is CBA's spending data broken down by age demographic, and it basically shows that, well, we've got an economy powered by people who are 55 and over, because everyone else's spending is growing slower than the rate of inflation. In particular, people aged 25 to 29 to 30 to 34, which is interesting. I think that it just goes to show that this whole idea that, avocado on toast and stuff like that is the thing causing inflation. Well, it might be true, but it's just not the young people eating it. It must be all the older demographics chowing down at the cafes and restaurants, driving that particular sector's strong retail sales figures.
But it goes back to this issue of value versus volume, right?
Yes, but I mean, I think the report from CommBank IQ said that particular that the older demographics spending in cafes was up 18.1%. So I think that's probably covering inflation and then some.
Absolutely, yeah, and it goes back to what we said on one of our previous shows about the unequal distribution across the demographics, right? From both an income perspective, from a wealth perspective, and from a spending perspective. It's the same old. Unfortunately, younger households, younger families are the ones being caught in the bow wave of this.
Yeah, unfortunately. Now, this is of total capital city property listings per 100,000 people. I've basically just did it in per capita terms just to adjust for any issues with population growth. And, well, I think it just tells the tale. Listings have collapsed in most of the capitals to a fairly significant degree. And it's also worth noting that, to be honest, listing numbers in 2019 weren't that high either, because they were amidst the issues with the Banking Royal Commission, falling housing prices at the time. And this predates as well the election in 2019, which was one of the catalysts that sort of refired the housing market. So I just think it just goes to show that, low listing numbers are really helping to support the market, particularly in places like Brisbane, Adelaide, and Perth, which have seen listing numbers fall by more than half.
Absolutely. But like I said, Hobart is going against the trend. I've explained why. Yep,
exactly. So it's going to be interesting to see how things go in that regard and going forward. And I think it's also worth noting that this isn't just an Australian problem, which I'll get to. I thought that was the next slide, but it's not. But, I think this is also a nice illustration of just how the previous 5-year average in terms of new property listings at a capital city level, which is what this chart's of, because for some reason I've cut it off by accident. The previous 5-year average is actually very, very low. It's actually well and truly below the decade prior to COVID. It's because obviously property listings were suppressed by multiple years of the pandemic, and also prior to that, the Banking Royal Commission and all the other things I just mentioned. So we are actually well below where we should be. And not only that, but that particular piece of data wasn't adjusted for population growth. So listings have well and truly collapsed. And I think it's just worth noting that as we discussed previously, how many of these listings are going to be postponed to a later date? And then finally, for whatever reason, it's going to have to happen because of life happens reasons. So I just wonder, when we could potentially reach that point, because it was okay up until about September, October last year. Listings were tracking relatively decently, but then they just fell away, and they just haven't recovered.
Absolutely. Yeah, well, in a single slide, it shows you the problem, right? And that's one of the reasons why prices are not necessarily destined to drop as far as many people were thinking, unless listings start to peak up, which is unlikely in the short term.
Yeah, and just on this one, I think is a good one, because basically this is for Canada. So we've got new listings on the left for April, and we've also got, and I quite like this one, we've got months of inventory based on current rate of sales. So at the current rate of sales, inventory levels are well below even 2020, 2018, 2019 levels, which were also depressed years for Canada because housing prices were falling. So I think it's interesting, just the fact that this is a global phenomenon, and it's the same thing in the US, all across the board. I mean, I believe by some metrics, the US is down by 44%, and I've stuffed up that particular titles, which I left over from last week. But anyway, so yeah, I think it's not just an Australia issue. So even in markets in the US that haven't seen prices fall as much, or even in Australian markets which haven't seen prices fall as much, say places like Adelaide, for example, which saw a continued run up even through much of the rate rise period, that is not the thing that is underpinning low listing volumes. It's something else. And to be completely honest with you, I don't fully understand what that is.
No, it is hard to read, but it's interesting that there's a mirroring. And by the way, you could look at the UK, and they've got a similar issue there as well with the same issues. So there are, I think these are fallouts from the the COVID period and from all of those things, the change in interest rates, a lot of different factors, and will probably take 4 or 5 years to really understand what really happened. I think it's too soon to try and predict what's going to happen, and it's certainly hard to read the recent data because it's moving around so much.
Yeah, it is quite challenging. I mean, like, I don't really know what happened in sort of September, October last year that really just changed the game, because things were sort of rising, and then they stopped, and that's not just it happened in Australia. It's happened in the US. It's happened everywhere. So, I mean, I don't know if it's because rates hit a certain level that people no longer could, you couldn't see so many people transacting because of, as you mentioned before, there are people who basically just don't have the equity to be able to uptrade into the house they want because they can't borrow enough. So, perhaps that's part of the issue, or, it's really, I mean, I'd be interested to see if you, one of the viewers have an idea as to why you think that's happening. I'd be curious to see you post that in the comments or tag me on Twitter. I'm well and truly open to theories.
Yeah, it's probably worth also overlaying the interest rate moves, thinking about it, because some of the interest rate moves started to bite 18 months ago, didn't it?
Yeah. We saw it, that I think the thing is that's when you really started to see things hitting their stride, because that's when you saw the big 50 basis points, or in some cases 75 basis points increases in mortgage rates.
Yep.
So, perhaps that is the thing underpinning it. But I mean, I guess the question is, how long can the Mexican standoff last? Can is this just the new paradigm where basically, people just sit on homes until something improves, or, something breaks? I don't know.
Well, I'll tell you what's going to break, and that is that most real estate agents will be out of business if it goes on like this.
Yes. 100%. I mean, they can't take it. They're going to be in well and truly in a world of hurt. Although, by the same token, if enough real estate agents and the ancillary related industries, the luxury car dealerships, the tailors, and everything else all go out of business at the same time, then we're going to see some moves in the housing market based on the rise in the unemployment rate, I guess.
Always a silver lining.
Yeah, well, I mean, it's all one big giant system, isn't it? It all feeds on. I mean, it all feeds on, on itself. Up on the way up. Housing prices rise. People want to buy more properties. Real estate agents go out and buy cars. They do whatever it is else that real estate agents do.
Absolutely. Well, remember I said that Andrew Bailey's models, he'd given up on trying to model it, and it shows you why this is a complicated intersecting set of data, data behaviors, all sorts of things. So maybe we should be a little bit more forgiving to central banks who think they can model it. The point there is you can't really. It's too complicated.
Well, my concern in all of this is that we're going to see, that we'll see potentially wages continuing to rise in places like the US and the UK, not necessarily continuing to rise in terms of their overall growth rate, but just still, remain strong and well above, the inflation targets. And even in Australia, if we see a reignition of housing credit and equity mate on the back of, just sort of, don't worry, rates are going to get cut, everything's going to be great, which is sort of firming in certain quarters as a sort of people are calling it a pretty likely scenario. And my concern is if that continues, rates are going to have to go higher. they're going to stay higher, and eventually they're going to break something. And the problem is the longer they stay high and the higher they go, the more likely they are to break something really big and really painful and really challenging. And it's going to get to the point potentially where we're going to wish that they just aggressively raised rates, smashed the economy into a recession, rather than, in a quick, relatively painless way by recession standards, rather than letting it fester over time, as the Bank of England has, to the point where you end up with a really long, protracted recession because the higher rates have done so much damage to other parts of the economy over time, because there's all these factors that weren't in the model, like, cashed up older demographics who are just going to keep spending because, well, why not? I was locked inside for 3 years.
Absolutely. Well, the slow burn versus the quick crash is a very interesting debate, because there are many people who say, well, if you're going to take the medicine, take it quickly and get it over with so that we can actually move through the cycle. What they're actually doing by trying to sort of, achieve a soft landing and all those things, and not necessarily being aggressive enough with rate rises, is they're actually prolonging the agony. And unfortunately, the longer you prolong the agony, the more collateral damage is done.
Yeah, and I think it's also worth noting that, especially in places like Australia, or even to a lesser extent Canada, who haven't had these same deep recessions that other countries have had, there's a lot of dead weight. Yep. There's a lot of zombie companies. There's a lot of people who a lot of companies who would dearly like to let go, but they just can't be bothered because it's too much trouble. Mm-hmm. And you multiply that by 10,000, 100,000 companies. There's a lot of people who are going to be on the unemployment line who aren't going to be spending at their personal trainer or the barista coffee or whatever. So, I think that there is that challenge there, and that's also why you should just allow recessions to occur organically, so you don't reach this point where there's so much dead wood on around the fire and the kindling that that if it really goes up, you've got a massive problem.
Absolutely. And I think those charts are really powerful. I think, as we come to the end of this conversation, the point there is that the slow burn versus the quick crisis is the real challenge, right? And I think central banks around the world probably are now realizing that this is going to take a lot longer than they expected to try and actually get things under control. The risks of recession are certainly higher, and the collateral damage, therefore, is very significant. And I keep coming back to the point that, wherever you look at it, not everybody is equally impacted here, but unfortunately, the proportion of people who are more and more being impacted and are finding it less and less easy to sort of manage through this part of the cycle really concerns me, because that is ultimately where the long-term damage will be.
I think you're right, and I think that's part of the problem. There was nothing in the budget, that really reined in the spending of the people who are driving the spending at this point, who are driving, the inflation, who are driving the economy.
Well, and what you're doing there is giving them some tax cuts shortly, right?
Yeah, well, exactly. They're doing that. They're doing that as well. And yes. I think that the problem is that if you don't target the people who are actually causing the spending, the problem is that you have to crush the people who aren't doing the spending even more, crush their spending down even further, so you can reduce aggregate demand in the economy. So, everyone's, sort of relatively just nothinged, shall we say, the federal budget, but really it's just put more emphasis on what the RBA has to do to contain inflation, because the government isn't helping.
No, that's right. Well, as we said at the start, you've got to say the politicians have a significant accountability, but they're not really wanting to take it, as well as the reserve banks around the world, the central banks. This is going to get messy. And like we said at the start, having been in circle mode for quite some time and trying to work out where the landing is, it looks as though we might be heading towards the landing a bit quicker than we'd like, and it might be more painful. So not necessarily good.
No, not necessarily. And I mean, by the same token, it might take a little bit longer, but that might also make the landing a little bit, quite a little bit harder as well. So
exactly,
it's going to be interesting.
Well, you and I will be back in a couple of weeks, and we'll be able to compare notes again and see all the stuff that's coming on. As always, really appreciated your time on the charts, and thanks to all those in the audience who asked the questions. And throw some more questions out for next time. We'll catch up again in a couple of weeks, Tarric.
Yeah, sounds great, mate. Looking forward to it.
Great. Thanks very much. See you later.
Bye, mate.